So in this video we will be discussing principles of working capital management. So there are mainly 5 principles of working capital management. The first we can say it is of cost of capital, principle of cost of capital. So we need to consider what are the sources from where we are financing our working capital, and the cost of capital and the risk are having adverse or negative relationship, so we need to make balance between these two. This is the first principle. Second is principle of equity position. So whatever amount of capital we are investing, so there we need to maintain equality with respect to the components of working capital. The components of working capital are major component are cash and stock or inventory, and then receivable can be there. So we need to invest in working capital in such a way that every investment contribute to the net value, to the net worth of the company, and increases the net value by using working capital. The third is principle of maturity of payment. So whenever the liability, the short term obligations become mature, at that time we should have the funds, we should have the funds to pay, to meet, to perform these liability. So we need to pay short term debt, and we need to pay some special arrangement for them. We can have quick convertible securities, they can be converted into cash as and when the obligation or liability arises. Then the fourth is principle of optimization. So with respect to optimization, it focuses on rate of return. So level of working capital should be maintained in such a way that the rate of return is maximized and the cost of capital is minimized. That is the optimization. So capital invested in each component, again in this case, as long as the equity position of the firm increases, we need to invest. Then the fifth concept is principle of risk variation. We can have three kind of situations here. The first is aggressive, conservative and moderate policy of working capital. So there is a direct relationship between the risk and profitability. As risk increases, the profitability will also, the chance of getting more profit increases. So first we can have large amount of investment into the current asset, we can increase our liquidity and we can reduce the risk in this way. But we need to forget the opportunity for gain of the firm, because now the firm cannot gain more, cannot get more profit, because the risk is low and the liquidity is high, we are playing safe. Second scenario, we can have less amount of investment into the current asset, we are reducing the liquidity, decreasing our liquidity position, and here we are taking high risk, more risk. And if we are taking more risk, then the opportunity for gain for the firm is obviously high, so here firm can get more profit, more gain.